Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So one of the companies that are on my watch list and I would like to add to this portfolio in the long run is Moody's. Moody's is one of those companies that have been on my watch list for quite some time. So what I want to do today is go over and some of the fundamentals and some of the data, what the company does and so on. So I'll give you a little bit of information and then at the end we'll look at the price targets for this company and I'll see if it's a buy for me right now or if I'm just gonna keep holding on to the watch list and then inside that watch list and leave it there for now until it hits that price target. But before we do that, as always, it would be really wonderful if you can join us in the Patreon account where you get access to all the dividend trackers that we use, the Sharia compliant investing ebook, as well as of course the Discord where you can get access to loads of brothers who are sharing actually wonderful basically ideas and stuff they do in the stocks that they're buying and so on. So Moody's has a 69 billion market cap right now, and as you can see here, year to date is actually down about 3%. And this is what attracted me to basically look at it again, because right now it has actually done nothing. It's actually been down for about over 3% since the beginning of the year, and now we're still in February. But that's, and considering every other company has gone so much, been going to the moon of the last few weeks, especially with all the AI situations. This company has not participated in that. So I want to see if this company is a buy. Right, so first let's start with this. Okay, so like I said, it's 69.4 billion market cap. So it's a large market, it has a large market cap. And like I said at the beginning, so if in terms of business, they have rating section, they have a research and insight, they've got data and information and decision solutions. So if we go back here, you can see the dividend yield is right now 0.9%. so it's nothing huge, but the growth is basically what I'm interested. But Moody's operates as an integrated risk assessment firm worldwide. It operates mainly in two segments. So they've got the analytics and the investor service side of things. So they rate they rate the debt levels of different companies, different countries, and all of that stuff, as well as of course they have a basic software as a service model, so basic solution supporting banking, insurance. And that for me is the most attractive part of their business. Of course, the rest of it is absolutely wonderful, but I like the fact that they've got that software as a service side of things, because that means a subscription model where companies cannot just basically move away from this company. So they're paying year or 2 years in advance to have access to their services, which is absolutely wonderful to see. And if you can pause the video and read the rest of them. But as you can see here, in terms of payout ratio, we're looking right now about 31%. And 10% is basically growth in latest increase was 10%, 12% in the basically last 5 years, which is absolutely wonderful. And this is probably one of the reasons I'm attracted to this company rather than the dividend yield, which is less than 1%. The growth side of it is what I'm interested, because if they have increased to 12% in the last 5 years and hopefully can continue doing that, and the last 20 years almost at 20%, which is wonderful. I'm not interested in the yield right now. I'm interested in that yield growing in basically in the next 5 to 10 years, and that's what I'm interested. As you can see here, that's the dividend growth in terms of the payout, the annual payout, dividend per share. 14 years of increase in that dividend, which is quite nice, and 25 years of without reduction. So they have not reduced it for 25 years, but they've increased it every single year for 14 years, which is nice. $3.40 is what you will get for every share of this company that you own. And right now it looks reasonably valued, because the 5-year average is 0.88. Right now is 0.90, so not far off. So it looks like fairly valued according to the dividend method. Now, a couple of more things. In terms of payout ratio, we say 60% is absolutely safe. 32% it basically is where it's at right now. Free cash flow basically payout ratio of 31 as well, which is very, very nice. Earnings per share has been increasing. 2021 is then absolutely wonderful. It has come down a little bit, but it also is expected to bounce back in the next 12 months. Free cash flow per share is also heading the right direction. In terms of shares outstanding, it's actually declining, so which is quite wonderful to see. So and sales actually are growing. So 2021 they have a wonderful year, then they have a little bit of decline, and now they're expected to bounce back from there basically in the next 12 months. Return on equity right now about 52%, which is very, very nice. return on invested capital of 19%, which is not huge, but it's good. Operating margin of 36% and free cash flow margin of 32% as well, which is nice. Net debt to EBITDA right now we're looking about is 1.78. Normally we're looking for anything below 3. So in terms of the dividend side of it, in terms of the business side of it, in terms of sales and basically shares outstanding, everything looks good right now. So a couple of more things we need to look at. So we need to look at the earnings, basic expectations for the next few years. So as you can see here in terms of EPS or earnings per share, we're looking at about 8% growth for next year. So there's about 20 and 8 different analysts basically that are looking at this company. So then 16%, so basically growing double digits there, and then again double digits after that and so on, which is quite nice. So this is one of the reasons I'm looking at this company, because if they can grow their revenue from $10 basically dollars to $12 basically in the following year, and then $14, that's basically decent growth. That's what I like. That's a steady eddy kind of business, okay? And the fact that they have a SaaS model as well is even added bonus. You got 10% next year in terms of revenue, which is quite nice. Then 9%, then 8%, then 6%, then 7%, which is absolutely fine. Now, in terms of the company reports basically recently, so they reported on the 13th of February this year. They've actually missed the EPS, but they beat the revenue side of things. And look, in terms of MA, was about 11% growth. The MIS systems that they use revenue grow about 19%. And when it comes to the operating margins, was about 33.6% and adjusted operating margins of 42.6%. And in terms of guidance, it was a slightly, maybe this is the reason why it was actually down. So they were expecting, the basic consensus was about $11.15, but their guidance is from $10.25 to $11, and operating margins of 37 to 39, and the basic operating margins 44 to 46, which is absolutely wonderful to see. Now let's have a look at the valuation side of it, see if it's actually a buy or basically a sell or whatever basically these analysts are saying. So if we go back here and go to ratings, so let's go to Wall Street first. So you can see there's 8 buys, 8 strong buys, 3 buys, and 10 sells, and 10 holds and 1 sell. Now 5% upside from where we are right now, $397 per share is basically where they think the price should be. Now looking at Morningstar, you can see it's 2 stars right now. That means it's expensive. So 13% premium right now. $335 per share is where they think the price should be. Right now it's $380 per share. The company has, of course, a wide economic moat. So it's interesting to see actually it's not far off, but it's just 2 stars right now. And total return in the last 10 years for this company, okay, it's about 17%, almost to 18%. So this is how much they're expecting the earnings to grow for the next, in terms of looking at Seeking Alpha, 16% basically for next year, and then 13% every year for the following 5 years. That's what they're expecting. And these Yahoo Finance analysts are saying $398 per share is where they think the price should be. Right now it's $376. And as you can see, it's almost a buy according to them as well. And now we're going to compare this company with its peers. So as you can see here, in the last 3 years, okay, comparing with these 3 companies here, these 2 companies here, as well as the S&P 500, 38% for the company, 39 for the S&P 500, 36 for this one, and 35 for this one as well. So not far off from, so they have actually beaten basically everybody apart from, actually they've basically beaten every single one of these, the S&P 500 and both companies as well. So in terms of the last 5 years, 128% return, 80% for the S&P, 81% for the S&P 500, 93% for this one, and 120% for this one. So again, it actually has beaten the S&P 500 as well as these 2 companies, which is quite nice. Last 10 years, 411, 169, let's call it 170, 260, 480. So the S&P and Global is the only company that actually beat out the S&P 500 is actually really not great. It's been it by more than twice. So again, it shows you this is one of the reasons I'm looking at this company is not just, by the way, don't get me wrong, the past does not tell us what's going to happen in the future, but of course the fact that they have that business model, they've been around for a very, very long time, and they consistently beating the S&P 500 in the last 10 years. And remember, when you pick an individual stocks, you want to try and get companies that will give you either the same returns or even better than the S&P 500. For us, it's quite difficult to own the S&P 500, so you want to buy companies that will either give you similar sort of returns or beat the S&P 500, and this is one of the companies. I've got a couple of more things I want to show you, and that's it. So the stock valuations, that model that I normally use, so the company, it's Moody's, as you can see here. The Morningstar valuations are 335, Seeking Alpha 397, and multiple valuation model, which I used to gave me 364, which is not far off from these two. Overall, $365 per share is basically the average of all three of them. And as you can see, currently $377. That means about 3% difference in terms of the two prices here. And if you add your margin of safety or 10%, that should be about $328. $330 should be a good entry for this company. So that means it has to come down about $30 from where we are right now. So my plan is just to add this company in the basically on my watch list, and basically for about this price. Maybe if 10% is too much, maybe you might want to do 5%, and that's basically 347. You can even go 350 if you want to, if you believe that the company is actually gonna do well in the next 5 to 10 years, whatever. So that's, inshallah, that's what I'm planning to do. I'm going to add it to the watch list and watch it in the next few weeks. If it hits my price target, of course, then of course I'm going to initiate a new position. As always, do your own research. This is kind of a bit of entertainment to give you like a little bit of overview, and I hope you're enjoying the content. It takes a lot of time to put these things together, so I would really appreciate if you can actually join us in the Patreon account if you can. And as always, just the least thing that you can do is basically like the videos, inshallah. Have a wonderful day. Assalamu Alaikum.